This morning, silver touched $85. Crude detonated to $119 and collapsed to $94. Gold spiked to $5,200 and got hammered $200 lower in the same session. Everything pumped. Everything dumped. Everything closed roughly where it started, but something specific happened at $85 silver. And it was not a coincidence. It was a collision. The metal hit the exact ceiling I have been marking for weeks and got shoved straight back to $80 before clawing its way back. Silver is not weak. Silver is trapped. There is a wall between where silver trades and where the math says it belongs. Today I'm walking you through the single chart, driving targets of 150, 280, and potentially 350s, every number, every step, so you can verify it yourself. Because the math almost stopped me from making this video. It is that extreme. The chart is the gold to silver ratio. As of March 9th, 2026, gold at $5,130, silver at $86.81. Ratio 59.1. 59 ounces of silver to purchase 1 ounce of gold. Every major precious metals bull market runs in 2 phases. Phase 1, gold leads. Central banks accumulate gold. Institutions move first. The safe haven bid flows into gold before silver sees $1 of reallocation. That is exactly what happened in this cycle. Gold ran from $2,000 to over $5,000. Silver moved from $20 to a peak of $121, both extraordinary, but gold led, and the ratio confirmed it, compressing from approximately 100 toward 59 over 3 years. Phase 2, silver catches up and overtakes. In the last comparable ratio compression cycle, gold up 33% from $4,200 to $5,600. Silver delivered 86%, a 2.6x multiplier. The ratio compressed from 65 to 46 in that same period alone. Phase 2 has not started. The chart is showing you exactly when it does. Pull a weekly ratio chart back to 2011. That year, the ratio hit a cycle low of 32. Silver at $49, completely outrunning gold. Then it climbed for years, peaking at 125 in March 2020 during the liquidity crash, 125 ounces of silver to match 1 ounce of gold. Silver was trading as near worthless relative to its monetary peer. Since that 2020 extreme, the ratio has been in a structural downtrend. Lower highs, lower lows. A descending channel, 5 consecutive years of compression. Now draw 2 lines, connect the descending peaks from 2020, connect the major lows from 2011 forward. Those 2 trend lines, one falling from 2020, one rising from 2011, are converging right now at 55-65 on the ratio. 2 15-year structures meeting at a single point. That is not a pattern, that is a pressure valve. Something breaks. The data tells you which direction. First ratio target, 40. That level held as major support across 2010-2012, tested across multiple market conditions over multiple years. Multi-year support zones become magnets. The numerator math, gold's bull market, has been advancing in roughly 20% increments. A pattern that has repeated 5 to 6 times in this cycle. One 20% move from current levels takes gold cleanly through $6,000. $6,000 divided by a ratio of 40 equals $150 silver, 73% above today's price. That is the conservative case. Second calculation, gold at $7,000. 2 consecutive 20% advances from current levels. The gold-silver ratio has compressed to 25 in every major silver bull cycle of the past 50 years. $7,000 divided by 25 equals 280 silver, more than 3 times today's price. Third, if gold overshoots to $8,000, $9,000 on war escalation, accelerated dollar devaluation, or a sovereign debt event, $350 silver sits comfortably within the same ratio arithmetic. The arithmetic supports it. I would not be shocked by that number. Here is where the chart math stops being theoretical and starts being physically driven. COMEX silver deliveries are at all-time records. 12-month average, 43 million ounces. Monthly spikes, 75, 80 million ounces, the highest delivery demand in nearly 20 years of data. Simultaneously, COMEX registered silver, metal actually available for delivery, has collapsed to 81 million ounces. Open interest on the exchange, 294 million ounces in paper claims. That is 3.6 paper ounces for every 1 physical ounce that can actually be delivered. 3.6 to 1. That is not a footnote buried in a delivery report. That is a structural fault line running beneath the entire market. Now, one number that competitor channels are not running. China's SHFE imposed silver export restrictions effective January 1st, 2026. China is the world's largest industrial silver consumer and controls approximately 13% of global mine supply. Restricted exports mean less silver flowing into Western markets. At the exact moment, COMEX vaults are being drained at record velocity. Both supply leaks are happening simultaneously. The Silver Institute projects the 2025 structural deficit will exceed 215 million ounces, the largest since deficit tracking began. Higher prices have not slowed this depletion. They have not bent the curve by a single degree. Every ounce pulled out of COMEX through delivery exits the exchange permanently. It goes into private hands. It cannot be leased, lent, or deployed to suppress the paper price. Short sellers depend on physical backing to maintain their positions. When that backing is being drained at record speed, the structural support beneath those positions is being quietly removed, month after month, at a pace this market has never seen before. The four largest COMEX silver shorts have cut nearly half their combined positions since 2024. JP Morgan alone stopped 3 million ounces in January deliveries. The institutions that can read registered inventory in real time are not debating ratio targets. They are pulling metal. When the short ceiling fractures, the ratio does not drift to 40. It collapses there, and then it continues to 25. Two legitimate arguments against this thesis deserve honest answers. Bear argument 1, supply response. Silver prices rise, mining profitability improves, production increases, price ceiling forms, standard commodity economics. The data does not support the conclusion. Silver has been in a structural supply deficit for 5 consecutive years through a price quadrupling. Refineries are at capacity. Solar manufacturing, semiconductor production, and defense electronics are consuming silver faster than mining can match. The mechanical reason supply cannot respond. A new silver mine from discovery to first production takes 7 to 10 years. No price signal accelerates a permitting timeline that does not yet exist. Bear argument 2. Silver is not a monetary metal. Central banks buy gold, not silver. Without a sovereign bid, deep repricing is constrained. True, and that asymmetry matters. But central banks have not bought silver yet. The absence of sovereign buying today is not a bearish argument. It is the opportunity window, positioned before that absence ends. The day a major central bank announces silver reserve holdings, this thesis defends itself. 3 scenarios break this thesis. 1. The Fed holds restrictive policy and the dollar index maintains strength longer than the ratio math assumes, delaying compression, not reversing it. 2. A global liquidity event forces institutional liquidation across all asset classes. 2020 showed silver can be temporarily crushed before recovering violently. 3. A viable industrial substitute for silver in solar cells or high-frequency electronics removes the industrial demand pillar entirely. I see no credible evidence of this in the near decade. Name the risks honestly, then execute on the data. Silver at $86.81 today, 100 ounces, $8,681. At 150, $15,000. At 280, $28,000. At 350, $35,000. Same metal, same ounces. The ratio repricing, exactly as it has repriced in every precious metals bull cycle in modern history. Now, the historical calibration. In 1980, the Hunt brothers drove silver to $50. Adjusted for cumulative inflation, that $50 represents over $200 in today's purchasing power, below my conservative first target. But set the manipulation entirely aside and look only at the structural conditions underneath that move. The 1980 supply deficit was smaller than today's. Industrial demand was a fraction of current consumption. Monetary debasement was less advanced. The geopolitical backdrop was less interconnected. The most extreme silver move in modern history, the one every analyst labels an anomaly, produces a price that falls short of my base case under weaker structural inputs. That is not an argument for silver. It is the calibration of how extreme today's setup actually is. This week, Iran struck Bahrain's water desalination infrastructure. 75% of Bahrain's drinking water comes from desalination. Kuwait, 90%. Qatar, nearly 100%. UAE, 90%. Saudi Arabia, 70%. This is not an oil infrastructure strike. This is a direct attack on the infrastructure of modern life itself. For precious metals, an event of this nature is not a standard flight to safety. It is a flight to the absolute. Gold and silver have held value through every empire collapse, every currency reset, every civilizational rupture for 5,000 years. No fiat instrument survives a systemic breakdown. They do. The ratio was already compressing before a single missile was launched, from approximately 90 in 2023 to 59 today, driven entirely by supply deficits, delivery demand, and short seller retreat. The war did not create the compression, it is accelerating it. When a 3-year structural trend collides with a macro catalyst of this magnitude, the move does not continue at the same pace. It explodes. The map, so you don't mistake resistance for reversal. First resistance zone, 100, 115s. Silver has never sustained trade above $100. The first breach will be met with intense profit-taking. That is normal. It is the market processing a historic threshold, not signaling a reversal. Absorb it. Second resistance, 115 to 120 wars. The previous all-time high at $121 carries overhead supply from the prior rally. Sellers still holding from that peak are parked here. Once the market absorbs them and silver clears $121, the character of the move changes completely. There is no overhead resistance above an all-time high, no bag holders, no sellers waiting at break-even. The roadmap, $86, pause at $100, push through 115s, break the $121 all-time high. Parabolic leg to $140, $150 consolidation, second leg toward $280 as the ratio compresses to 25. Drop your ratio target in the comments right now. Does silver pause at $150 before the run to $280, or does it clear $150 and accelerate straight through? Tell me if the war changes your timeline. I will pin the best analysis from both sides. Subscribe and hit notifications. Every video on this channel goes this deep. COMEX delivery reports, ratio mechanics, short position tracking, vault inventory. This is what we do here. The gold-silver ratio has been building this setup for 15 years. Two trend lines are converging today, March 9th, 2026. The shorts are running, the vaults are draining, the setup is now. This content is for educational and informational purposes only. Nothing in this video constitutes financial advice. Precious metals markets are volatile. Always conduct your own due diligence before making any investment decisions.